Hello everyone, my name is Samar. I am the head of Asia for a business called Talos. We sell trading technology to firms on the buy side and the sell side of financial services. And what we wanted to do today was share with the community a lot of the lessons that we've seen by helping hundreds of customers trade institutional digital assets at institutional grade scale. And so the topic of today is called the building blocks for institutional digital asset trading. And I'm going to go over the goals of the session, and hopefully it's useful for you guys. So who might this session be useful for? So you might be someone who's considering starting your crypto fund. You might work for a hedge fund that's maybe assigning some or allocating some assets to digital assets now. You might be an asset manager or a corporate treasurer. Or on the sell side, you could be a bank that's setting up a trading desk for your customers to trade Bitcoin. You could be a fintech app that is trying to offer now the ability for their customers to make payments in stablecoins. There are so many different use cases of institutions that want to start either investing directly or offering digital asset investing services. And there's you may have heard that it's not that easy, or there's a lot of learnings that you have to go through on this pathway to setting up your digital asset service. So what I'm going to cover today is why are institutions trading digital assets at a very high level, why we're here today, the practical pathways to getting exposure, the challenges and risks that institutions have, why is it hard compared to the traditional finance world to work with digital assets, and then how do you get past that, right? And that's the meat of today, which is the key building blocks that you should take away so that you understand when you go back to your firm, how would you set up your digital asset trading journey. And then we'll go over a quick case study, and hopefully we'll have time for Q&A. I think overall this thing should take about an hour. I'll try and be crisp, and I'll try and move through sections fast if I feel like they're not relevant. Request that you maybe keep your questions till the end so that we can maintain the pace. But if there's something urgent, let me know. What we won't cover very quickly is what is the use case for crypto or digital assets, stable coins, CBDCs. What are your favorite blockchains? We're not here to discuss that. I'm assuming that people understand the potential of digital assets already and are trying to now practically think about how they're going to invest in them at scale. I'm not here to recommend counterparties, including my own. We might mention certain vendors or exchanges for illustrative purposes, but my goal is not to tell you who you should work with and who you should not work with. You should do that due diligence yourself, but I will help you think about how to score and value the different vendors out there in the ecosystem. I'm not here to give regulatory advice because the rules are different whether you're a hedge fund, whether you're an asset manager, whether you're a bank, whether you're a fintech app. It's just different in whichever country you're in. So do your due diligence there. And obviously, we can't go into detail on everything. I've tried to compress this into a really useful 1-hour session. And of course, hopefully, please respect the Chatham House rules in that these are just my private views only. But again, hopefully useful for you. So who am I and why are you listening to me? Why should you care? At a very high level, I'm a technologist who worked over 20 years in global banks and traditional finance, and then for the last 5 years in digital assets. I started my career building trading systems when markets were first getting connected in the early 2000s. And my last role before I left banking was at Deutsche Bank, building out the digital asset strategy there, whether it was custody, trading, etc. And so I've seen the journey on the traditional side moving into digital assets, but I've also been on the digital asset side helping crypto native firms. And I'll get into what we do, but basically our firm has a very unique vantage point of what institutions are doing because we're helping many of them in the background. We're a firm whose name you might not know because we are a B2B software provider, but we work in the background powering a lot of hedge funds, a lot of banks, a lot of brokers. And so we can see what pain points customers have faced, or institutions have faced when setting up their digital asset trading journey. Very quickly, I don't want to spend too much time here. We are a B2B software as a service provider. We sell trading infrastructure from OEMSs to PMSs. What we do is we work with firms on the buy side, the sell side. We're the largest provider in the world of this software, and basically double-digit billions are trading through our pipes on a monthly basis. That's just the scale that we are able to operate at. And so keep that in mind when we try to talk about scale and trading. So, pause. Why are institutions trading digital assets? Why are we here? I'll try and make it very quick so we can get into the meat. But investors want exposure to digital assets today, and we'll talk about what we mean by digital assets because there's many different types. But first of all, they present diversification, right? You've got exciting new asset classes. Some are performing like commodities. Some are performing more like speculation or currencies. But these are exciting new asset classes that are emerging. People want to invest in the future of finance, right? You want to have this idea that you can invest in the next Google or the next Facebook or whatnot, given that we are going through a revolution in finance. For risk management, right? Often we've seen certain types of digital assets as being useful for hedging against currency risk or certain macro environments. Speculation, let's not pretend. There are a lot of speculative trading happening in digital assets where people are seeing arbitrage opportunities or they're looking for very high returns. And then there's this idea of yield enhancement. There are ways to generate yield through new concepts such as staking, and we can talk about that too. Very quickly, just to level set on what the types of digital assets are, because digital assets is a very wide term. The first subset of digital assets that we all know are cryptocurrencies, for example, Bitcoin, Ethereum, where their value is determined by either scarcity or utility or their tokenomics. So keep that in mind. Crypto is a subclass within digital assets. You have stable coins, which are very popular today. You may have heard of USD Tether or Circle, and these are pegged to fiat, but represented on blockchain, and they are very commonly used for settlement. You also have a very exciting new type of digital asset class emerging called tokenized assets or tokenized real-world assets, which are assets that are represented on a blockchain but backed by something in the real world, whether it's a bond or real estate or art or some illiquid asset, and bringing the benefits of blockchain technology, which is quite exciting, right? Because a lot of people believe that the pie for tokenized assets is going to be a lot bigger than the pie for crypto today. Having said that, a focus of today is really going to be on the first two, crypto and stablecoins, because when we see institutions trading at scale, that's what they're trading. Over time, there will be more opportunities to trade tokenized assets as this asset class matures, but right now, there's still a lot of work needed to be done. There are also people who talk about central bank digital currencies, which are more like a type of fiat, but issued by a central bank. And of course, we all know about NFTs, which are more like collectibles and IP powered by blockchain. We're not going to talk about much of that today, given that we're focused on institutional trading of digital assets. So, when we talk about getting exposure to digital assets, what do we mean? How do investors get exposure? So there are two paths, and before we get into the detail, I just want to separate the two paths, right? Firstly, there's this idea of indirect exposure, where you can use a traditional means of financial product to get exposure to this exciting new world, let's say. And we'll get into what I mean by that. And this has much lower risk, and the barriers to entry are pretty low as well, because you might already have a brokerage account, you might already invest in ETFs, for example. And then there's this idea of direct exposure. Direct exposure is when you actually hold Bitcoin, for example, or when you stake some coin. This has higher risk, but this is what I mean when you are really accessing all the investment opportunities offered by this fast-growing ecosystem. And so today's focus is really on direct exposure, practical guide to getting direct exposure. Very quickly, though, for you to understand what I mean by indirect exposure, is, you can invest in public or private equity by buying shares in Coinbase or MicroStrategy. You're still getting exposure, right? You can invest in venture capital by making a fiat cash investment in an early stage infrastructure companies. You can invest in a fund that is actually investing in crypto. These are all hands-off approaches. You may pay someone to do a managed account for you, a wealth management type offering. Or you can invest at the Chicago Mercantile Exchange in Bitcoin futures. It requires old technology because most of the banks today are connected to the CME. And your existing stock brokerage account has ETFs, and you can buy the Bitcoin ETF today, right? The BlackRock one. So all this stuff is available to you today if you want indirect exposure. And if this is your interest, you don't really need any guidance from me. But let's talk about direct exposure, why we're here today, and what you need to know to get properly set up if you want to, at an institutional grade, be able to trade digital assets. So what are we talking about here when I talk about direct exposure? I'm talking about investing in token projects. Maybe that's an STO. I'm talking about long-term value investing, where you're buying Bitcoin over time and holding on to it. Maybe you're an asset manager or a pension fund doing that. Directional swing trading, some macro hedge funds do this, where they buy in during periods of growth and sell out during periods of bear markets, but they are able to generate yield and return. There are firms that know very well how to trade volatility, and crypto markets are very volatile. How can you make money off that using certain types of derivatives trading strategies? That exists. There are arbitrage strategies that experienced traders from the worlds of FX can see, whether it's to do with pricing discrepancies or being able to do sophisticated trades like the basis trade, or you are trying to do high-frequency trading, which is to do with low-latency price differences between exchanges. These are folks taking direct exposure. There are systematic firms that are looking at signals from social media, from news, and they have proprietary investment models, and they trade based on that. There are firms that are doing mining, so they're working on blockchain, they are crunching numbers and trying to generate Bitcoin. There are firms that are staking. We'll get into that, but basically institutions that are trying to generate yield by staking their assets through different blockchains. People are lending, and there are firms that are market making. The whole point is that each of these activities are what institutions are doing today, and they all carry their own risks, their own capital requirements, and they all have their own expected yields. But these are examples of what I mean by direct exposure. So why do you need to attend a 1-hour presentation on getting set up professionally to work with digital assets or to trade digital assets? Well, there are challenges and risks if you're an institution that wants to work with digital assets, especially when you're taking direct exposure. So let's try and align on what those are before we talk about how to mitigate those risks. So when you're an institution like a bank, a broker, a hedge fund, and you say, okay, I want to trade digital assets, there are some initial questions that come to mind. I've heard about these hacks. I've heard about losing private keys. So how do you secure these assets, and how do you transfer them at scale? How do you connect to all these different blockchains? I've heard there's a Solana thing, there's an Ethereum thing. How do I connect to them? How do I participate on these blockchains? How do I do this in a way that's responsible, i.e. regulated and licensed? And how do I do all of this at scale? It's not, maybe all of us in the room know how to buy, $100 worth of Bitcoin on a Coinbase account, right? But we don't know how to buy $10 million worth of Bitcoin in an hour. And there's a whole different tooling that you need to set up to be able to do that. So how do you do this at scale? So a lot of the obstacles that exist for institutional adoption are around 4 pillars. The first one is around liquidity. In today's digital asset ecosystem, liquidity is very fragmented. You have exchanges and you have OTC desks, but they use different types of connectivity, different types of APIs. It's confusing, and you have to work with new names. You can't work with your typical New York Stock Exchange, NASDAQ, SGX. You're working with new names. Working with new names means new counterparty risk. Which names can you trust? Which names are operating more opaquely? This is important for you to figure out. Capital inefficiency. When you trade on public exchanges, you often have to pre-fund before you can trade. That's very different from institutions today that actually have credit lines. And so some of these clumsy things that basically came out of the retail side are very much a part of the ecosystem today still, although there are solutions coming out to solve for these. But you need to be aware of them. A lot of the reason why digital assets took time for institutions to come in is because for the first time, the innovation came from the retail side instead of from the institutional side. Typically, the institutional side is where the innovation happens, and that trickles down to retail in traditional finance. In the digital asset world, it happened the other way around. And that's why it took time for professional providers to come in to help institutions to work with digital assets safely. And we'll talk about how they help. But what it means is, as an institution, you have to learn about the new tech stacks that you need to put into place to connect to these markets and to trade them. What are the risks when you work with digital assets? It seems like it's a high risk, high reward kind of situation, right? We talked about connectivity, no standards. Markets go down sometimes, right? Reliability is less. We talked about liquidity and the fact that there's not so many prime brokers or credit options. We talked about the reliability of venues. We talked about this idea that you might have issues with getting hacked. How do you prevent that? We talked about the fact that there's a lack of regulatory clarity around the world. All these new operational models that you have to put in place to become 24/7. Remember, digital assets trade 24/7. Can your business support that if someone's trying to do something at 4 in the morning on a Sunday? There are new types of tools you have to learn on the AML side or know your transaction side because opponents of digital assets feel that this is an area that it has a lot of loopholes for cybercrime, sanctions, etc. However, there are a lot of tools out there that help you mitigate this and actually show a lot more transparency than what exists in today's fiat markets. And just technology, right? You have to learn about new technology. The growing pains of that is something to get around. But the good news is that there are tons of firms out there that are offering professional services that will help an institution like yours to mitigate all these risks. And we'll talk about that now. What are the differences that you need to know between traditional markets, though, and digital asset infrastructure? Let's talk about them really quickly. On the liquidity side, in traditional world, you've got hundreds of venues and exchanges. In the digital asset world, it's like I said, it's fragmented, right? On the exchange side, the exchanges in the traditional world, they're very neutral, they're highly regulated. In the digital asset world, some exchanges are providing custody as well and brokerage. So you have to understand the difference between a pure exchange or an exchange plus. In the traditional world, we've got standards like SWIFT for messaging and FIX for trading. In the digital asset world, you've got blockchain, you've got APIs like REST and WebSocket. You have some with FIX, so it's a little bit fragmented, it's annoying. The custody is very different. You have all these global custodians that you work with, like Bank of New York Mellon and State Street in the old world. In the new world, you have two options. You either custody yourself, which is a completely new idea, using technology and wallets, or you use a third-party qualified custodian, but it might be a name you're not familiar with. It might be Coinbase, it might be HexTrust, it might be Anchorage, it might be BitGo, but you have to figure that out. Settlement is used, in the old world, is done with clearinghouses and often T+2 territory, right? Everything is instant here in the digital asset world, and that makes your operations needing to be very finely tuned. In terms of ownership, the ownership of your assets is determined in the old world by central securities depositories and your custodians, whereas here in the digital asset world, you have to understand you're dealing with private keys. These are bearer instruments, and that means that custody becomes very important. In terms of credit and tooling, massive differences as well, because in the traditional world, you have many options, but in the new world, like I said, there were a lot of retail tools, but not institutional. That's changed now. So let's talk about what I think are the key building blocks for an institution that wants to connect to digital asset markets. The first one is custody. How do I secure and move these assets? Do I use self-custody or do I use a third-party custodian? We'll talk about that, how you think about that, how you value that. The second one is liquidity. Who am I going to trade with? Am I going to trade with an exchange? Which exchange? Am I going to trade with one of these OTC desks or market makers? Why? Why should I choose one of them versus an exchange? Is there a prime broker that will let me talk to all these exchanges? The third building block is the technology and the tooling, right? How are you going to use tools? By the way, the text there is wrong, right? How are you going to use tools to professional tools like an OEMS or a portfolio management system to aggregate liquidity and perform algorithmic execution? Some of this software is now available for digital assets, and it's working really well. And the final piece is your operating model, okay? I can't stress this enough. It's not a technology thing, it's a process thing. Remember, we talked about the fact that you're now operating at 24/7. You're going to have compliance staff who have to use new processes on what coins they accept, and did it come from the dark web? And how does your treasurer settle for your trader? These are new processes, so your operating model is really important, and that includes your license. What we've seen as a best practice, a tip, is that firms who are very successful have all four of these pillars very, very nicely sorted out, and they typically digitize the workflows between them to orchestrate between these building blocks when they are in the process of pre-trade, trade, and post-trade. And we'll talk about what I mean during these activities. So let's go through them one by one, right? We've got custody, we've got liquidity, we've got technology and tooling, and we've got the operating model. So let's talk about custody first. So why is custody important? In digital assets, custody is the first and most important step for institutions to figure out. It's not like the traditional world where a custodian is something that is considered a commodity, and you know that your assets are not going to get lost because the CSD is also tracking your ownership of those shares or whatnot. Because we're talking about bearer shares, and the owner of that bearer share is determined by whoever holds the private key, the manner in which you hold that private key is the key to everything. And that's why the custody solution that you choose is very important, because that's how you prove that you own the assets, and that's how you move the assets. It's very different in the digital asset world and on blockchains compared to the traditional world. And I believe custody is more important than traditional finance because of this. And so you have to think about custody being protecting and moving the assets, and the safekeeping of the keys. So what are the options that you have for custody, right? So between you and I, when we're trading, we can either use one of these browser wallets like a MetaMask or something like that. Maybe you've heard of that. It's free, but it's not really it's not really institutional friendly, right? Like, you have risk, there are attack vectors, people could keylog your keyboard. There are lots of holes in this. The second approach is you can use those hardware sticks. You've heard of Ledger Nanos and Trezor wallets and things like that. There's a decent level of security there, but can you imagine a bank or a trading firm plugging that thing in, that stick in, and trying to move assets and taking it out and plugging it in at all hours of the day? It's not exactly scalable for an institutional business. The third option you have is leaving availing of the custody provided for you by the various exchanges. We all know that that's probably not a good idea. Even though it's easy and fast and convenient, look what happened to FTX, right? There's this idea that not your keys, not your coin. If you're leaving your coins on an exchange, typically, the exchange is in control of them because the exchange is holding the keys on your behalf. So we don't recommend for an institution to use any of those first three options. Option 4 and option 5 is what you should be thinking about, and it will vary based on your goals. So option 4 is what I was talking about when I was talking about using self-custody tech providers. There are firms, you may have heard of them. You've heard of Fireblocks, Copper, Metaco, Taurus. These firms are selling technology that let you hold your assets yourself. It's a new thing, this idea of holding them yourself. But if you're a hedge fund, a private hedge fund or a private crypto fund, you can do it. And you don't even need to deal with an outside custodian like a Bank of New York Mellon. You have full control of everything, and it is military-grade security, very difficult to hack. You have to pay for it, though, right? And you have to set up the operation around it, around how, when you want to transfer your Bitcoin from your Fireblocks wallet to your Coinbase exchange, who's going to approve that? There's some complexity there that you have to own. The fifth option, which is, I would say, 50-50 between institutions, is you use a qualified third-party custodian. Sometimes they are licensed, sometimes they offer the same level of military-grade security, but you're kind of outsourcing that whole management of and movement of the assets to them. The risk is you're trusting a third party, right? Now, these firms, they sometimes offer insurance and guarantees. You have to do your due diligence, and I'll help you with that. Like I said, option 4 and 5 is the typical option that if you're an institution, you have to go with. So, what are the considerations you want to make? I'm not going to go into the detail here because custody is a whole different world, and you have to do your own due diligence on your custodians. But there are debates going on about whether this technology, MPC, is more military grade than this technology, HSM. Do your research, but different custodians are using different technology. Different custodians offer certain availability to certain coins that you can custody. They can't always custody all the different types of coins. So choose a custodian that can custodize the coins that you want to work with based on the connectivity that they have to various blockchains. There's also this idea of hot and cold storage. Typically, cold storage is much more secure and has a lot of insurance guaranteeing its safety. Hot storage is more when you can move the assets quicker, but maybe it's slightly less secure. There are different models of how when your treasury is holding your assets, how much you keep in cold versus hot. Some regulators demand that you keep some in cold versus hot in certain ratios. So do your research on this offering too. Certain custodians offer wallet structure features, such as Omnibus, where all the assets are held in one wallet, all jumbled together, and you keep a separate position ledger, whereas other custodians allow you to have a different wallet for a different sub-account. So this complexity is something you have to manage. And again, like I mentioned, some of them are licensed and regulated, some of them are not. And they are all working on innovating and improving their offerings, giving you access to staking, giving you easy transfer and settlement tools. So evaluate that. And a very new theme, especially for this year, is that the custodians are offering this very interesting concept called off-exchange settlement, where they're doing deals with a lot of the exchanges out there so that you don't have to move your assets away from your private wallet onto an exchange before you trade, and that's very convenient for your capital efficiency and your settlement risk mitigation. So this is something, again, that you have to kind of wrestle with and get your head around, but this is a new theme this year where a lot of custodians are starting to offer off-exchange settlements, so ask them about it. Let's talk about liquidity next. I know I'm kind of moving at speed here, and I hope it's not like, I know it's a lot to absorb, but I really want us to get through these 4 pillars, and then we can get into questions and stuff, yeah? So thanks for your patience. Let's talk about liquidity, okay? So we talked about why liquidity was fragmented and what are our options, right? So here are the 4 options that you have for liquidity. You can work with a public exchange, you can work with an OTC desk or a market maker. There are now ECNs emerging and some private liquidity pools, or you can work on a DEX, right? A decentralized exchange. So the first 3 do not have anything to do with blockchains at all. Think of them as low latency marketplaces, just like Carousel or like the New York Stock Exchange. They don't have blockchain elements. The last one does, okay? So what are the pros and cons of each? If you're using a public exchange, it's fairly easy to self-onboard. You have a lot of retail money there, which is sometimes good for institutions. You can deploy algos and save on your fees by breaking your order into small pieces and sending it to different exchanges to save on your execution. But the cons of working with exchanges are often, and this is very clumsy and unique to crypto, in order to trade at an exchange, you have to pre-fund. You don't trade with a credit limit. You want to buy 10 Bitcoin, you have to put 10 Bitcoin worth of money onto the exchange first, then do your trade, and then move the Bitcoin back to your private wallet. So there's that, which is a big no-no for some institutions because it creates settlement risk. And then you've got some regulatory uncertainty around exchanges. Not all your exchanges are the same. Remember that. Some are very regulated, and thus they offer a lot less coins, and others are more opaque, operating at the edges, but they have great pricing, right? And you know that these names. Then you've got the OTC dealers and market makers. You and I may have probably never traded with them, but institutions are trading with them. The names that you may have heard are Cumberland, B2C2, Coinbase Prime. Like, these are firms that are offering, well, actually not Coinbase Prime. These are firms that are actually market making on different exchanges, or they operate OTC desks that are exclusively for institutions. And the advantages of working with them is that they give you credit limits. You can, they're like, oh, I know you, Millennium or Point72. I'll give you like a $10 million credit limit. You can settle with me at the end of the day. It's much more convenient for the trading desk to do that, right? When you do a block trade, like maybe you want to do a $10 million trade and get out of a position, you can send an RFQ to them, and you might get a better price than if you were trying to do the same on an exchange. It depends what you're trying to do in that moment. The disadvantages are that typically they have less coin coverage. It depends. And they won't give you an RFS, which is like a streaming order book. Maybe you have to work with them for quotes. Not all of them, some of them. Now, ECNs are a new type of liquidity option that's coming into play, copying from what we had in FX. They offer a lot of transparency, and you can get direct market access and good order execution. But obviously, it has its own cons. Sometimes they have limited order types, not as much liquidity, and sometimes you can experience slippage. Let's talk about number 4, DEXs, okay? Decentralized exchanges are exchanges that are built on blockchains. It's exciting technology. The jury's out as to whether a central limit order book on a blockchain is better than a central limit order book on low latency technology. But what are great about DEXs are those weird esoteric coins. You can find them there. So if you want to get in and trade a coin early, sometimes only a DEX like Uniswap will carry it, right? And the cons of working with them is that it's hard to predict your fees because sometimes you have gas fees working directly on blockchain. And the biggest one for institutions is on the KYC side. It's really hard for institutions to be able to justify working on DEXs because often on the reg side, they're supposed to know who their counterparty is in a trade. And when you do a swap on a DEX, you don't know who your counterparty is. The tip that I would say here is you select a mix that's right for you, right? So if you're a hedge fund and you want to only work with really regulated liquidity venues, I would say pick a few public exchanges like Independent Reserve and Coinbase and OSL, for example, because they're very transparent about their licensing. And then maybe you work with a couple of OTC desks like a Cumberland or a B2C2. And then what you do is you onboard with all of them and maybe aggregate liquidity across them so that you have a good balance of optionality for you. And so you get good savings on your execution. That's just a friendly tip. How would I score, or how do we think about liquidity venues? I'm not going to go into too much detail because there's a lot of ways that you can score them, but feel free to take a photo. This is a good list that you should think about when you are trying to score the liquidity venues you want to work with. What coins do they offer? What's their order book depth like? Do they offer an RFS versus an RFQ feed? How is their pricing, the tightness of their spreads? Do they give you these volume-based fee tiers where if you trade a lot, they really charge you very little? Do they offer derivatives? Because you might be trying to do more sophisticated trades like a basis trade where you want to trade spot and future. How regulated are they? What's the settlement situation? Do they give you credit limits or do you have to pre-fund? Because one of them is much more capital intensive. How painful is the onboarding? And that could be a good thing or a bad thing. What is the quality of their APIs? If you're a systematic firm, you're not going to their GUI, you're just connecting to them via API. Is their API reliable? Does it go down? What's the latency like? If it goes down, how quickly does it come up? How stable is this exchange known to be during volatile markets? Does that exchange go down? If it goes down, do they have a good redundancy in Tokyo if New York goes down, for example? We've seen during volatile markets, exchanges go down all the time. It's annoying, but there are ways to mitigate that by having redundancy, multiple connection lines to different exchanges, using an OEMS software provider like ours that can try to help you preserve your order state and trade somewhere else if an exchange goes down. There are ways to mitigate this. And what order types do they allow you to do? Can you do complex algos, or is it just a limit order or a market order? That matters. Think about all these things. As well as that, how much influence do you have on their roadmap? Are they a real exchange? How pure is the liquidity? Or are they just another broker aggregating liquidity from somewhere else, charging you a lot, and you don't know it, right? I talked about recent themes, ECNs, off-exchange settlement, and institutional-focused exchanges. These are adding really good maturity to the market. Prime brokers. Let's talk about prime brokers really quickly. The use of credit intermediaries is really popular in FX and equities, right? You would use one of the big banks like a Goldman or a Morgan Stanley or a Credit Suisse back in the day. Prime brokerage offerings are still in early stages in digital assets, but they're important because they help you outsource your account opening to all these exchanges. So you just do it once with a prime broker and you can use their sub-accounts and you get access to all the different exchanges. They can sometimes give you credit and they can sometimes take care of your treasury and settlement. Do your due diligence on the various prime brokerage offerings out there because none of the prime brokerage offerings are as good as what banks have today for FX and equities. But in the digital asset world, there are different levels of prime brokers. Some are offering only sponsored access, which means you open an account with them and you can trade on all the exchanges without opening an account on every exchange. And then there are others that allow you to do that, plus they have a balance sheet to give you credit. So you may have heard of names like Hidden Road or LTP. Do your due diligence and figure it out. And another way to mitigate your counterparty risk when thinking about liquidity is using liquidity aggregation and connective redundancy. I talked about that. Let's talk about technology and tooling. We're halfway through. Let me just check the time. Oh, good. We're still doing okay. Yes, so technology and tooling. So why is that the fourth pillar? Why is that important? So I don't know what you guys' backgrounds are, okay? But before I worked in professional finance, I thought that when you trade equities, it was you log into your Charles Schwab, you log into your interactive brokers, and you do your trade, right? I think we all know now from our years of experience in finance, I would guess, that a professional trader has a much different toolkit, right? When they use market connectivity, think about Bloomberg, they're getting real-time pricing from different markets at very low latency. They're able to aggregate liquidity from different venues so that when they trade the best price at any given moment. That's something that an individual user doesn't really have access to. They use things like an order and execution management system. That ensures best execution. If you don't know what an OEMS is, go research that. But basically, it's a platform that lets you aggregate liquidity and run algorithms that let you break up your orders into small pieces and send it to different exchanges so that when you are trying to do a very big trade, there is no slippage. Because when you drop a very large trade on an order book, that price will move against you and you're not going to be able to execute that trade or get in and out of your position in a way that's cost effective for an institution. And also proving to your end customers that you got them best execution if you're on the sell side is something that regulators are going to start asking. In my car, they've already made it mandatory in Europe, that when you're trading on behalf of your customer, you have to show them that, hey, I went to the market and I saw all these prices from Bitcoin, from Coinbase, from Gemini, from Genesis, from B2C2, and this was the best price. That kind of audit trail is something an OEMS can provide you.
Sorry, what is OEMS?
An order and execution management system. Yeah. And it's a popular tool used by traders and banks and hedge funds in FX, equities, bonds. TMS, Treasury Management System. Remember, you've got someone sitting with the trader, topping up funds at exchanges, settling intraday, and looking at wallets on the blockchain and making sure that everything's safe. Treasury management is really important. So having a treasury management system, which is similar to custody, but offers more sophisticated tools, is important. PMS, we all know about portfolio management systems. How do you look at your risk across your assets? In the professional world, asset managers look at their Greeks, their NAV, their VAR. They're trying to do scenario testing. They're trying to do post-trade analytics. These are tools that professional traders are using. And then finally, they're getting all of this at institutional grade. So when I log in and trade on Interactive Brokers, it's very different from when someone at 0.72 is trading with a major stock exchange. They're using a prime broker. They're getting will they have 24-hour support? Will it be a low latency line? Will it be tested and updated all the time? This is kind of what I mean by the Pro Traders Toolkit. And by the way, this is the area my company operates in. So we offer solutions around this space. But there are also competitors of ours that offer solutions within each of these verticals. So again, do your due diligence. But when you want to set up to face a market and trade a market at scale, you will need these tools after your custody to work and trade efficiently and at scale and safely. And figure out who are the providers that you want to give you your risk management, to give you your treasury, to give you your OEMS and your market connectivity. That's all I would say. Additional considerations, we talked about the lack of standards, so use a firm that gives you connectivity so that you don't have to build it yourself. Integration, how do these software vendors let you integrate with your in-house systems, because you want to work with your existing in-house systems. The reporting tools, you're going to have to do drop copies to downstream systems like for your fund accounting and your tax, for your audit trails, and your uptime and reliability, right? Crypto markets go down. How do these vendors have this built in? So in terms of the technology and tooling, when I talked about that toolkit, what are your options to getting that tech so that you can work with it? There are three options really, and this is the dilemma that goes on from the dawn of time, which hedge funds and banks are dealing with even to this day. You can either build it yourself, you can rent the tech by working with a provider like us or someone else, or you can acquire the tech, like you acquire a team, you acquire a company. And each of them have their pros and cons, right? If you build it yourself, you own the IP, you're not leaving money on the table, but it's going to cost you a lot of money, and there's risk in execution, and you're making your engineers do things that are not necessarily core to your business. What I typically advise firms that we talk to is your alpha, if it comes from your investment model, have your engineers focus on that. If your alpha on the sell side comes from your customer experience, have your engineers focus on that. Not on commoditized technology like connectivity and data and things like that, which professional firms are outsourcing for you. The use case of renting or using a third-party provider is that you have this immediate time to market. You can kind of pay as you scale, and you've outsourced this commoditized tech. Of course, you're leaving some money on the table by working with a third-party vendor, and if the vendor is good, there might be painful switching costs. The third option happens from time to time, though. If you're a big bank or you're BlackRock and you're moving into digital assets in a big way, you might just acquire a company, right? You might just acquire a team, and you own the IP. You've got a fast time to market as well, but it's going to be a massive upfront cost. You're going to need lawyers and M&A experts. That deal might not go through, right? When you're evaluating vendors, consider these things. This is another useful list. I'm not going to go through it in detail, but feel free to take a photo again. How do they deploy? Is this vendor need to come to your server room and install it on-prem, or is it a software as a service? Is it a dedicated infrastructure for you, or is it shared with other customers? What's the tech debt that this vendor has? Have they taken an old trading system, like from FX, and tried to repurpose it for crypto, which, by the way, we think is a bad idea? Or is it a new stack built for the digital asset world and built for blockchains? What's the throughput of this vendor? Like, are they built for 100x of today's crypto volume? Is the support model really 24/7, where you can access engineers? What's the pricing like? Is it flexible, or is it like a very expensive upfront annual licensing fee? When you do your due diligence, go through an RFQ process, go through sandbox testing, compare vendors against each other properly to see which ones work best. Some of these vendors are startups. This is a new world, right? Do your due diligence on the startups. Find out what is their runway, get client references, what's the pedigree of the team, who are their financial backers. Are you, in terms of cost, are you being cheap for the wrong reasons? Because there are many offerings out there that say they do the same thing, but actually what you're getting is a prosumer offering versus a premium offering. And there's a difference when you look in the detail in terms of the support you get, in terms of the throughput and the scale of the machinery. You typically get what you pay for. So when you try and cut costs somewhere, you will lose out somewhere else. So just know what you're paying for, and if a vendor is expensive, find out why. It's funny for us, we are considered more of a premium vendor, and often we have firms who say, oh, we're just going to build it ourselves, but they come back to us in 6 months because they realize it's not that easy, or they realize that the cheaper vendor that they went with didn't give them any support, for example. So just do your due diligence. And then their API offering, right? You don't always want to use a vendor's GUIs. They should be API first so that you can unbundle their products and integrate them with your existing systems. Finally, operating model, the last building block, and then we'll go into a summary and wrap up. But the operating model is one of the most important pieces, and I left it till last, but it is one of the most important pieces because it's not about fancy technology, it's about business process. But it's really important because firms don't realize when they move into digital asset what it means. Like the simple idea of what 24/7 markets means doesn't mean that your operations person needs to man a desk 24/7, like even more than FX. And when you are settling things instantly, the capital efficiency is amazing, but the risks go up as well. And so how do you set up those approval workflows? And so that's what the operating model is about. So let's get into what it is. The operating model is about your legal entity. Have you structured it correctly in the right jurisdiction? Have you gotten your licenses? You have to do your due diligence there, talk to your lawyers, whatever. Onboarding. You're onboarding new vendors and new counterparties. That is a lot of paperwork and a lot of legal work. You have to do that well. This I cannot stress enough. Your staff, the way they have to upskill and coordinate is very important because here you're going to have traders working very closely with Treasury. Treasury is important here, and you know why, because of custody and settlement. Ops, risk, compliance, all working together very, very closely, using new tools. You're having to build new internal processes for policies, procedures, your custody policy approval engine. How do you approve that transfer of 100 million worth of Bitcoin from here to there? Very important. Treasury operations. I mentioned Treasury being really important. It's because when everything is instant, when you can move assets around instantly, traders are able to do things that they couldn't do because their money is not locked up in settlement, right? So traders are suddenly capital efficient and they want to trade all day long. In order to do that effectively, the person in Treasury that's sitting next to them needs to support them in either pre-funding their accounts, settling credit with OTC desks, or staking or moving assets from different wallets. The way that you set up your Treasury operations to support your trader is really, really important to move at speed and capital efficiency. Your compliance posture, maybe less important if you're like a private crypto fund, but if you're on the sell side, now that you've got assets coming in from customers that could have come from the dark web, or it could be stolen or whatnot, you've got new obligations of KYT, which is know your transaction. You have to prove sometimes to regulators that the funds were reviewed for using blockchain analytics companies you may have heard of, like Chainalysis or Elliptic or TRM, that are experts in looking on the blockchain at your coins that have come in and saying, yes, they're clean. So you have to have a compliance team set up to actually use this new tool to go through this, and also your travel rule obligations. Travel rule is something set up, again, for KYT, for large transfers to have due diligence on them, to know where the funds have come from, where the coins have come from. Your downstream systems, how do you do your tax correctly and your fund accounting correctly? The importance of FX. I cannot state this any louder. FX is really important with regards to crypto because of two reasons. One, a lot of the best pricing for crypto trading is in USD. You might not be working in USD. You might be a Singaporean firm that's financed in Singapore dollar. So you are creating FX legs, FX to USD, USD to Bitcoin. And so the way that you orchestrate your FX together with your crypto trading is really important. And there are tools to help do synthetic trading like that. And also the way you settle. If you're settling with a local exchange in Japan, maybe you want to settle in yen, so that FX piece becomes important again. And the last piece, which causes a lot of pain in the digital asset world, is to do with your fiat banking on-ramp, off-ramp. Why is this so important, and what do I mean by this? What I mean by this is when you're funding your digital asset trading desk, or you are trying to cash out all your earnings, at some point you want to move from US dollars into crypto and from crypto into US dollars. That's what we talk about when we talk about on-ramp, off-ramp. The vehicle that you use to do that is super important, and it's challenging because banks are scared of digital assets, and many of them don't want to bank even well-known institutions. That's changing, and you have to do your due diligence on which banks are good for your on-ramp and off-ramp. Some exchanges offer on-ramp and on-ramp because they are very regulated or they've done very good deals with banks, and other banks can help with your on-ramp, off-ramp. But it's important for you to figure this part out. This has become the slowest leg in the digital asset world today because stable coins and crypto move at the speed of blockchains, i.e. they can settle instantly within a minute or two. The fiat leg becomes your slow leg. And so how you move your cash into a stable coin or into Bitcoin and then trade it, and how you do the opposite becomes very important. The idea here, though, is that this is a new paradigm for many firms, this 24/7 market thing. So can you move at this speed? You have to think about your operating model. Let's wrap up. Thanks for your time. Let's wrap up. So let's summarize what we learned. There are many options you've learned today about how you mitigate your risks, right? Connectivity, you can use an OEMS. Liquidity, diversify your liquidity. Don't just work with one exchange. Work with many exchanges and OTC desks. You'll get best execution, and if they go down, you can still trade. InfoSec, don't get hacked by using an institutional custody technology provider or a third-party custodian. On the reg side, do your due diligence, get your licenses. On the operational side, build a robust operating model. On the AML and compliance side, use the blockchain analytics tools, the travel rule vendors. They're out there, right? I mentioned some of their names. On the travel rule side, there's a company called Verify VASP based here. There's another company called Nota Bene. Do your due diligence. And on the technology and tooling side, we strongly suggest you don't build it yourself. Obviously, I'm biased here, but rent tech from the best vendors. They're laser focused on that. Very quick use case. If you're a small fund and you want to get set up to trade, there's many different ways you can do it. You can trade in custody yourself. That's what we do. You can work with a one-stop shop. Like maybe you go onto Coinbase and you just say, okay, I'm happy working on Coinbase. I'm happy working on Binance. That's it. I'm fine. It's convenient, but you create a single point of failure. The third option, which we feel is the most professional, is you face the market, which means that you have your own custody provider and you onboard with lots of different exchanges, and that way you're getting best execution. And the last way is you try and do it yourself. You try and build all of this yourself. It's a bit of a headache, but some firms can do it. They have a lot of engineering talent, and their expertise is in this space. So I'm going to end with an example of a small buy-side firm that wants to trade crypto. What they typically do is they will go to a one-stop shop because they don't want to deal with custody, treasury, settlement. I just want to trade. I just want to learn about how to trade Bitcoin. Can I generate yield? They will typically go to a one-stop shop. That one-stop shop will give them custody plus some brokerage, and they will probably have their own exchange, right? Like this, for an example here, could be Coinbase Prime. This is a good starting point. If you're a $10 million fund, maybe you're going to learn a lot here. The pros is that you only are on board with one provider. You've outsourced your custody, your AML, your reporting, and it's a fast time to market. The cons, though, is that you're working with one provider. It's not really an institutional grade setup. You're not facing the market. You've got higher trading fees or whatever trading fees this exchange charges you, and you're not getting best X by arbitraging across exchanges. And the coin availability is restricted to whatever they offer. A more professional setup, and one that we often help firms with, you don't have to use us, you can use someone else, but this is a better setup, we believe, for institutions, is if you're a hedge fund, you figure out who your custodian is, you onboard with a whole bunch of liquidity venues, like we said, 5 to 10 exchanges and OTC desks, and you're going to be in good shape. You use an OEMS like a Talos to orchestrate between all of it. You even consider using a prime broker so that you don't even have to open all those exchange accounts, and suddenly you're in business. This is a more professional setup. The pros here are that you've got from a single screen, you can orchestrate across all these providers. You've got a lot of fault tolerance built in if an LP goes down. You can ensure you get best execution by getting the best price always. This is a more institutional grade offering, and you're always going to be getting constant features from your tech providers here, from the custody side, from the OEMS side. The cons are, yes, it's a little bit more work up front. There's some friction there, right? That's it. I hope it was helpful. I know it was fast, but I hope it was a nice 101 into how you get set up professionally. Thanks. If you have any more questions or you need to learn more about this stuff, we will be releasing a guide, a 101, a PDF, and about this kind of stuff, and happy to share more with the community. But the idea here was to share with the community what we think institutional best practices are if you want to trade digital assets at scale, whether you're on the buy side, whether you're on the sell side. Thank you. Yep, questions?
2 questions.
Yeah.
Thank you very much. The first question, do you have any license, or you don't need any license?
We are a tech provider. We don't need a license. When a retail exchange or a fintech app or a broker or a hedge fund uses us, it's a software as a service. They just use our software. They still have to onboard with the different liquidity venues, and they still have to be licensed if they're providing a brokerage service. Maybe in Singapore with the MAS, DPT.
Okay, yeah. So another question, as you said, most of the FX are depending on the US dollar, right? US dollar, USDC, DT, everything. But we are in blockchain, we are in decentralized world. So we are depending on the centralized something.
Yes.
Do you have any ideas on how to?
Yes. So there's 2 ways that you can de-risk this whole FX thing, right? So what the gentleman here is saying is that most cryptocurrency pairs are priced with USD as the base, right? Many of us work in USD, and for those of us who work in USD, that's fine. If you happen to be working in yen or Aussie dollar or Singapore dollar, then you need a solution. The 2 solutions are, 1, work with exchanges that have figured that out. So there are local exchanges that allow you to settle in local currency. So for example, in Singapore, CoinHacker, okay, you can settle in Singapore dollar. In Australia, I'm working with Independent Reserve, I can settle in Aussie dollar, whatever. So you choose exchanges that have other currency pairs. I know B2C2 has a lot as well. The other tool you can use is what we call synthetic FX pairs, which means you take an FX trade, which is USD to your local currency, and then a USD to crypto trade at the same time. And for example, at Talos, we have a tool that allows you to do that seamlessly. So you can get best pricing with the FX leg built in to your crypto leg. And for that, you will need an FX provider. We are onboarded with a few, like LMAX or Sukden. But you can provide your own FX if you have a local bank relationship with DBS or Standard Chartered, and provide your own FX rates and de-risk yourself from that FX and still get best pricing because that's available on USD.
Oh yeah, because actually I have one. So
yeah.
So like currently, like considering the high volatility of crypto markets, like what happens the recent like stock market crashes, or even one of the token collapse in I think 2 years ago, if I can recall. And I wonder how you apply like relevant like mathematical and statistical models, like for example GACH, like generalized autoregressive conditional heteroscedasticity, models to predict the future price volatility of the like tokens, like things like NFTs that I think that we discussed earlier. And I wonder what are the key variables that you would have included in your like models, like when you came out with your products, and how you interpret the results coming out from that.
Yeah, so you're touching on certain areas of risk management that are quite advanced, right? And it might not suit everyone in the audience. But what I would say is that when you are running a book and you are an investment firm that has its own proprietary models, you may have applied some of these mathematical formula to your portfolio, right? Based on that, you may decide that the market is volatile. I can either make money from this by doing straddle trades or whatnot, by combining derivatives and spot, or I want to get out of this position because I think something's going to go down. Your proprietary investment model is what's going to give you an edge on the market, and that's your alpha. We don't provide that. We don't provide tools like that, like Talos, for example. But there are firms that do it very well. And what tools we provide would be like standard Greeks or standard scenario analysis that might try to emulate a flash crash of like 2 years ago. But we won't be able to predict it. Like systematic firms that use our platform for execution, they are quite good at predicting this stuff because they're looking at a lot of signals and using machine learning algorithms to do this stuff. Yeah. Sorry, there was a question back there. Yeah.
So I just wanted to ask, quite similar also, if I'm a prop desk and I have my own systematic trade,
yeah.
Obviously if I do it in-house, it's secret to me.
Yeah.
But if I use Talos, on Talos side, how do you guarantee that this is still a secret?
That is a very good question, okay? That's a very good question. It's a question firms ask us a lot, and it's one that we have a lot of material to share with, right? To make that safe. No staff at Talos. So when Talos sets up an environment for a firm, what we are doing is setting up dedicated infrastructure in the cloud for you, right? So the connectivity lines, the database, your positions and P&L, that's set up in the cloud for you. It's not shared with other clients, and it's not on a Talos machine. It's on a machine that Talos has set up for you, but the people that have access to that machine are none of the Talos staff. There's maybe 1 or 2 people on the engineering side and tech support side who are able to restart processes if they fail, or fix a certain connectivity line if it goes down, like to restart that. But we are not in the business of trading, first of all, so we can't front run any of our clients. We are a tech provider, and we do have the trust of some of the largest hedge funds and systematic funds and prop desks in the world. It's not our business to take advantage of that information. Yeah, but you're right that is a concern of build versus buy. Yeah.
You mentioned that Talos have access to the data. Where is the data stored?
No, it's usually on a cloud, right? So if we use AWS or Google, that data and those connection lines are sitting in a server room in Tokyo or wherever you choose to deploy. Because what we usually say is, where are you situated and where are the exchanges situated that you want to trade at? And we deploy an optimized setup for you for latency. And usually you will say where you want it deployed.
How do you...
It's like a managed service.
Yeah. How do you, like the security system in place to assure of the integrity and the privacy of the data?
Yeah, so look, we are audited. We have our SOC 2. We are audited by PwC. This is our whole business, right? It's the bread and butter of what we do. The fact that people should not be able to log into those machines and see what customers are doing is part of our bread and butter. We came from, like our CEO was the head of trading for AQR Capital, and our CTO built a lot of the FX trading platforms for Goldman and BNP. So this is what we've done for the last 20 years. It is one of the new trends that more and more firms are getting comfortable with, just like using cloud. If you're a bank, in the old days, you used to build everything in-house, but now you're like, okay, I'll use a vendor. I'll use BlackRock Aladdin, I'll use Bloomberg 360 FX Go, I'll use 360T, whatever. This idea of using a vendor will always require some trust, but you have to do your due diligence on the vendor. Understand and ask those exact questions in an RFQ and say, in your security, who has access to the box? What can they see? Is it hashed? The key, all of that, yeah. And you'll find we provide assurances to our customers for that. And because we don't trade, we're not incentivized to profit from this.
I wonder how does your product test for market efficiency, let's say especially in cryptocurrency exchanges that your product provides, and I wonder how does it assist in ensuring market equilibrium, although sometimes volatile as far as I understand. But how you ensure that there's market equilibrium, especially even cryptocurrency exchanges, as well as how you ensure the welfare economics involved?
What do you mean by market equilibrium?
Market equilibrium is something some kind of balance of the demand and supply, they're all intersecting at a point or things like that. And then I guess market equilibrium and economic theory like this, and I wonder how does it ensure the welfare economics, the involvement of welfare economics in the initiative of cryptocurrency exchanges.
So look, again, we are not an exchange. What you're talking about, again, is like marketplace theory, right? Like supply and demand. And so every exchange, that's a real exchange, has what they call a central limit order book. And you have buyers and sellers, and you have market makers. And those market makers are there to create liquidity by making markets, and they make money from the spread. And you have buyers and sellers that are there to make the marketplace real. In what you're describing, in that economic theory, that's how we arrive at a price, right? And that price will stay or move up and down based on other market conditions. We are not an exchange. What we do is connect to every exchange and just pull in their prices and create an aggregated order book so that you don't have to worry about building individual connections to every exchange. So I don't know if I answered your question, but I don't know if I'm in a position to either.
I just want to clarify how does the product ensure that the benefits of welfare economics involved, and I wonder what are the challenges involved in ensuring this.
I don't think we are. Yeah, that's.
I see, from an economist's point of view, the welfare economics part of it.
It's a little bit out of scope. We are not involved in welfare economics. I don't really understand that. Yeah.
One last question for Samar. If no more questions, I think we shall close the session. But before I close, for members of Digital Assets Association, we recorded the talk just now, so you will have access to a copy of the video recording. Those who are interested and not a member, do consider joining. And also watch out for our next event 2 weeks later on crypto ETF. Thank you. And a big round of applause.